Real estate investment trusts have performed incredibly well over the past year, and as a result, some of them have now become overvalued. Therefore, I think that now would be a good time to review your REIT portfolio and ask yourself whether you want to sell some of them going into 2025. Hey everyone, this is Jules. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to highlight 3 very popular REITs that I would consider selling if I own them today. But before I get into it, I want to let you know that I plan to do a partial portfolio reveal on this YouTube channel, so if this is something that could interest you, make sure to subscribe to the channel and also please click the like button. So the first REIT that I would consider selling is called Tanger. Its ticker symbol is SKT. This is the only REIT that specializes in factory outlet centers. It has some close peers that own malls like Simon Property Group and NAREIT in the US. However, they're a bit different since those tend to focus on Class A malls. Tanger instead focuses on these factory outlets, and it has massively outperformed its peers over the past few years. It has performed really well to the point that it's now trading even at a premium to the pre-pandemic period. And to be fair to Tanger, the company is today doing really well. It's enjoying growing cash flow, growing dividend, and these strong fundamentals are largely the result of the strong supply-demand dynamics that enjoy the retail property sector. If you think of retail, it has now been out of favor for nearly 10 years, and as a result there are very few developers who are building new properties, yet the demand for these properties, especially the well-located ones, keeps on growing, and the high inflation of the recent years has led to rapidly growing sales per square foot for their retailer tenants, and this is now allowing these landlords to significantly bump up their rents. But there are 2 reasons why I'm not bullish on Tanger, and the first one is the valuation. The company is now trading at about 17 times its FFO, at closer to 20 times if you adjust for the capex that it has to pay to keep its properties in good shape. So that's quite pricey in my opinion for retail REIT, and especially so because of the second reason, and it is that I fear that the company is going to suffer some long-term headwinds because of its unique focus on outlet centers. Here what you need to understand is that outlets and traditional Class A malls are very different in 2 ways. It's in their location as well as in their layouts, and from both of these perspectives I would much rather invest in malls rather than outlet centers. Typically, Class A malls are located in prime locations in highly urban cities with good access to public transport, a significant and rich demographic surrounding the mall. But in comparison to that, outlets will typically be a bit further outside of the cities where land is cheap and abundant. You typically have to drive 30 to 45 minutes just to get to the outlet, but consumers will still go there expecting to get lower prices. But this becomes increasingly an issue now with the growth of e-commerce, with one-day shipping for companies like Amazon, and now you also have discount retailers like TJ Maxx building these new kind of like mini outlet centers in more convenient locations for consumers. And so I think that simply competing on prices is going to become increasingly an issue in the future. Here the Class A malls are better protected by having these prime locations. Real estate always comes down to location. I'm sure you've heard that before. And from this perspective, I think that malls are much better positions than outlet centers. And then the second difference here is in the layout. Typically the layouts of Class A malls are very flexible, and you can include a lot of different types of uses that are even non-retail. So in the mall you'll typically have a lot of services, entertainment, you may have even some office space like a co-working office. You'll have a lot of different uses, even some healthcare like a dental clinic. But with outlets, it's a lot more complicated. Typically, the layouts are, it's 1 story, it's very flat, and it's vast, it's large. It's mainly designed for retail, like fashion and accessories, and those are the retail sectors that are the most impacted by the growth of e-commerce. Right now, the company is doing really well. It's enjoying growing cash flows, and to be clear, I don't expect this to become a significant near-term headwind for the company, but my fear is that over the next 10-20 years, over the long run, this is going to hurt its fundamentals and eventually lead to underperformance relative to the REITs that own Class A mall properties. Despite that, Tanger is today priced at a sizable premium relative to some of its peers like Simon Property Group, NAREIT, or if you look even in Europe like Klépierre, or in Canada, RioCan. And for this reason, I just think that Tanger is overpriced based on the fact that most investors are focusing on the near term and forgetting about the bigger picture. I think that it should be the opposite. It's the Class A mall REIT that should be priced at a premium relative to Tanger. And so I think that the risk reward is relatively poor. For this reason, I would sell Tanger. I would much rather invest in one of its peers like RioCan in Canada. The second REIT I would consider selling is called Welltower. Its ticker symbol is WELL. This is a REIT that we used to own for a long time at High Yield Landlord, which is my REIT newsletter, by the way. If you want to access my full portfolio and all my transactions in real time, you can join us for a 2-week free trial. It will be the first link in the description of this video. But so this is a REIT that we bought during the pandemic, back when senior housing was really struggling. It was oversupplied and people were scared of moving into a senior housing facility because of the risk of contagion and getting sick with COVID. But because of that, the valuation was really low, and we predicted that these properties would eventually recover, and this recovery is now today taking place. The cash flow of Welltower is rising at a really rapid pace. The market loves it, and it has now priced it at a very expensive valuation. We agree that the company is likely to keep doing well over the coming years, not just because of the continued recovery from COVID, but also because the supply-demand dynamics have materially improved in this sector. But I wouldn't pay 30 times FFO for it, and because the issue is that while these properties are today doing well, I think that we are likely to see another cycle of oversupply sometime the next 3 to 5 years, because the strong performance will inevitably attract a lot of developers into this sector, hoping to earn good returns by developing new properties. And so I think that oversupply will come again sometime in 3 to 5 years. This rapid growth won't last forever, but the market has now priced it at a pretty hefty valuation multiple, and for this reason I'll rather sell it and buy one of its close peers like National Health Investors, ticker symbol NHI. It's a similar REIT that owns senior housing properties, but it's much smaller in size and it's trading at a significant discount. I think its valuation multiple is about 2 times lower. Or perhaps you may want to buy a REIT like this and pair it with another healthcare REIT like Alexandria Real Estate, which we have often covered on this channel. It focuses in life science buildings. It's today priced at one of its lowest valuations ever, trading at just around 13 times FFO. There are a lot of opportunities in the healthcare sector, and therefore I'm not interested in buying Welltower today. And then the third REIT I would consider selling is called BXP. This is one of the biggest office REITs in the world, and it's not nearly as expensive as the 2 other REITs that we highlighted in this video. It's today trading at just around 12 to 13 times FFO. And a lot of value investors are pitching it as an investment opportunity because its valuation multiple has contracted significantly in recent years due to the COVID crash, the surge in interest rates, the fears of remote work. And so a lot of value investors are buying it today thinking that it's cheap and that it would recover and see some multiple expansion as people return to the office. But I'm not buying into this. On the contrary, I think that the company is actually quite expensive at 12 to 13 times FFO. And what investors here are not really considering, in my opinion, what they are overlooking is that this 12 to 13 times FFO is based on yesterday's cash flow. And it's unadjusted for the capex, and that's really the issue, because I think that REITs like BXP have done relatively well in recent years because they own these Class A properties. A lot of companies, as they move to a hybrid work environment, they have been shedding their Class B space to refocus on Class A properties, and as a result BXP has done quite well. But what I feel will happen over the coming years now is that a lot of these Class B properties will change hands. They will get new landlords who will come in with much lower bases, and this will then allow them to heavily reinvest in the properties and redevelop them to make them more competitive with the Class A stock that exists out there. And so in recent years, REITs like BXP have not experienced that much competition despite the rising vacancy rate in the office sector. But I think that in 2, 3, 4 years from now, we'll see much more competition as these Class B properties get redeveloped into something that's more competitive with Class A. And this will put more pressure on the occupancy rates and rent levels of the properties owned by BXP. This will then force BXP to heavily reinvest in its properties to keep them desirable and give large tenant improvement packages to their tenants. And so this will drain a lot of their cash flow. If you take that into account, I think that it will trade based on forward FFO at closer to 16 to 18 times today, and that's not cheap in my opinion for an office REIT that focuses on coastal markets and has questionable long-term growth prospects. I think that there are much better opportunities in other property sectors, and therefore I'm staying completely away from these office REITs at this moment. That's all I had for today. Please click the like button. Remember to subscribe to the channel as well. Let me know in the comment section below what other REITs you would consider selling at today's prices. Thanks so much, and see you at my next one. Bye bye.